So in today's video, I'm going to be explaining the pre-approval process from start to finish, everything that you need to know. I'm also going to be sharing different tips and red flags because you might be working with someone already. You get to the end of this video and you're like, wow, they did not do any of that, or they're doing it all. But either way, it's important for you to know. And if you're new to my channel, my name is Meredith. I'm a mortgage broker. I put out educational videos every single week. So make sure you hit that subscribe button. Now let's get into it. Okay, so here's the overall timeline of when to get pre-approved. So when you're about 6 months out from buying a house, you first want to talk to a lender, get all your questions answered. What I do with my clients is I ask them specific questions up front during this time to see if there's anything that you need to work on. And then we come up with a really good plan that you need to work on in the meantime. Then in about 3 months out from buying a house, that's when you actually want to get pre-approved at that time. And a big red flag is if you get a pre-approval letter without even speaking to a lender. A lot of big companies do this, and there's a lot of intricacies that goes into getting pre-approved. So just know that pre-approval letter is not actually solid. Now let's go over the first step on getting pre-approved. Okay, so there's really 3 key factors that lenders and banks look at whenever you're getting pre-approved. And number 1 is going to be your credit score. Now your credit score directly impacts what your interest rate is going to be. So the higher your credit score, the better interest rate you're going to get. Now your income and how much debt you have is going to directly impact how much buying power you have or how much your pre-approval amount is. So the more income that you bring and the less debt that you have, the more you'll get approved for. And then number 3 is how much savings or how much cash you have in the bank, because that's going to impact your down payment and your cash to close. Now these all work together. You can't have one without the other. Now a good tip is multiply your yearly income by either 3 or 4. And this will give you a rough estimate of how much your pre-approval amount is or how much your buying power is. So for example, if you have a yearly income or your household income is $60K, if you have a lot of debt, multiply it by 3, you'll probably get approved for somewhere in the 180 range. Now you multiply it by 4 if you don't have much debt, and this will put you in the 240 range. Now this is really important. Do this up front so that this will set up your expectations correctly. Okay, so here's the pre-approval process. Now this is specific to what I do, and I first want to talk to you over the phone. So you can schedule a phone consult with me. And I don't directly just send you to a link right up front to fill out a loan application. And the reason is I want to get to know your situation, what's going on with you. I want to answer any questions that you have up front for me. And when I'm going through the phone consult, I'm hitting those key major factors of the pre-approval. So I'm going to be asking you questions about your credit score, where it's at. I'm going to be asking a lot about how much income you have, how much debt, how your income is structured, how long you've been at the job, do you have a 2-year job history. This is probably the most important key factor of the pre-approval process because like I said before, it directly impacts how much your pre-approval amount. And a lot of times lenders don't ask a lot of questions up front, and what ends up happening is you send in the documents, they don't look at it, or they don't really understand, then you go under contract, then the underwriter starts picking apart your income. If you're hourly, why aren't you working 40 hours a week? Why are you working 32 this week, 34 the next week? And all of this can be avoidable if you ask the right questions up front. Now, I'm also going to be asking you how much money you have in the bank, because that's going to depend on how much you have for down payment, if you need to do maybe a down payment assistant program. And my main thing is I'm going to be identifying any roadblocks up front. And we're going to come up with a plan for this. Now, a big red flag a lot of lenders do is not giving you guidance and not really giving you options on what to do. Now, here's what you'll know coming out of the phone consult. So number 1, you're going to know how much your pre-approval amount is. Number 2, we're going to go over the type of loan that's going to fit your needs and why that works the best for your situation. And number 3, we're going to be going over the estimated monthly payment of how much your pre-approval amount. And this is really important because how much you get approved for might not be comfortable or where you want to be as far as monthly payment, how much you want to afford. So at the end of the day, you know your situation better. So we go through different scenarios on monthly payments, and I'll give you, hey, if you want to be at this monthly payment, here's a rough estimate of the purchase price where you need to be at. And number two, we'll go over how much you need to know for your cash to close, which is your down payment and your closing costs. Okay, so the next step is going to be sending in your documents. And the reason we ask for these documents up front is just to verify, to make sure that there's not going to be any issues with your income. These are the documents that the underwriter is actually going to be looking at. So we just want to make sure that all the income calculations, everything is correct up front. And if you're a W-2 employee, so you work for someone, you work for a company, then we're going to need to look at your last 30 days of pay stubs. And we're also going to need your last 2 years of W-2s. Now, W-2 is the form that you use to file your tax returns, and you get them at the end of the year. Now, if you're a 1099 business owner or you're self-employed, then we're going to need to see your tax returns, and specifically the last 2 years of your last 2 years of filed tax returns. And what we're looking at on these tax returns is your actual taxable income, which is your income minus all of your write-offs and expenses, and that's how we get to your actual taxable income amount. Now, let's say everything checks out. Let's go over the next step. Okay, so now that we've looked over your documents and everything checks out, the next step is I'm going to connect you with a realtor. And since I do loans across the US, I have a really vast network of realtors that I work with, because the main thing, especially if it's your first time, is you want to work with someone that's experienced and knows what they're doing. And here's the thing, number of years in the business does not equal experience. And the reason is the real estate market is changing yearly, sometimes even every 6 months. So you want to make sure that you're working with someone that's actively doing deals in the current market so they know what's going on. And you also want to make sure that your lender and your realtor is working together throughout this process as well. Then from there, you're going to start looking at homes. You're going to do the home shopping. And here's a pro tip. What I do is I'm going to be involved when you're out shopping for homes with your realtor. And the reason is I'm going to be running estimated monthly payments, estimated numbers on whatever house that you've actually found. And the reason is property taxes can change from house to house. You could have one house that the property taxes are $200 a month, and then you can have another house which is the same purchase price and the property taxes are $400 a month. So it's very important that you do this up front. Also, I'm not going to actually be doing a hard pull until you've actually found the house that you like, you're ready to submit an offer. And the reason is it can take a lot of time for you to, between the pre-approval process and actually finding a home, and it doesn't make sense. We do enough work up front. It doesn't make sense to pull your credit up front if you don't find a house until another couple of months. Now, let's go over the overall time frame from getting pre-approved to getting the keys in your hand. Okay, so here's the overall time frame from getting pre-approved all the way to getting the keys in your hand. Number one, like we said before, about 3 months out before you plan to buy a house, that's when you actually want to get pre-approved. Now, the pre-approval process doesn't take long at all. It takes about 24 hours. Then after you're pre-approved, the home shopping process, it can take some time. It can take anywhere from 1 to 3 months. Now, once you've found the house, you went under contract, generally speaking, the amount of time it takes to get the keys in your hand takes about 30 days. Now, this can get sped up. Fastest loan I've done is about 10 days, and it can take a little bit longer. It just depends on what you and the seller agree. Now, let's go over the 4 major types of loans. So number one, you have an FHA loan. Now, FHA loans are generally speaking good for those that have a lot lower credit score, around a 620 plus, or they have a lot higher debt load on a monthly base. Number two is going to be a conventional loan. Now, this loan is good for those that have a little bit better credit score, generally speaking around a 680 plus, and also want to put down a higher down payment than the minimum amount. Then you have USDA, and these are for those that want to buy a house outside of the city limits in a rural development. You don't need a down payment with USDA loan. Then you have a VA loan, which is for those that are either active or have been in the military, and that's also 0% for a down payment. Now, you do have down payment assistance programs, and with down payment assistance programs, they are not their own separate loans. What they do is they're either coupled with a FHA or a conventional loan. And what it does is it covers the down payment. Now, it's important to understand the stipulations that come with down payment assistance, because it's never free money. You either have to pay it back within a certain period of time, or you're going to get a little bit higher interest rate, but you don't have to pay it back. So it's important to know this up front. Okay, so if you're buying your primary residence, so the house that you're going to be living in, here's the minimum down payment that you'll need for each different type of loan. So number one, if you're doing an FHA loan, you'll need 3.5% for the down payment. If you're doing a conventional home, conventional loan and you're a first-time home buyer, then you'll need a 3% for the down payment. Now, if you're not a first-time home buyer, then the minimum down payment is going to be 5%. And with a USDA loan, there is no down payment, so it's 0%. Same thing with VA loan, it's also 0% if you're buying your primary residence. Now, if you're buying an investment property, then the minimum down payment is going to be 20%. So if you're planning to buy a house and you want to know exactly how much your buying power is, how much you'll get approved for, click on the link in the description, schedule a call, and I'll be in touch.